Hi, this is Derek with Trading Animal, back with another weekly summary for the week ending February 16th, 2018. So what we're looking at today, we're looking at a chart, a daily chart, to start off with, of the S&P 500 futures. So you can see the last couple weeks, we had a significant 10+% decline. It came down and tagged the 200 simple moving average, bounced back one day and then back down over 2 days back to that 200 simple moving average. And then this past week we've actually had a fairly decent rebound off that 200 simple moving average. So now the question is it just a simple retracement back to it's currently at that 618 retracement line? Is it just going to be a retracement and then we reverse back down lower for new lower lows, or is it going to have the strength to push through that 618 retracement and on up to fresh new highs? We don't know the answer to that yet, but we'll take a look at the charts here and a couple other market internals that may lead us in one direction over the other. So next, let's look at the cash, S&P 500 cash. Same as the S&P 500 futures. This chart again bounced off the 200 simple moving average, and we're up to that 618 retracement. We still have on my chart here the price projection, the 100% price projection, which actually kind of started the reversal, started the decline. It's a long time price projection that we've been watching for quite a while. The market did come up to that, tag it at that current high of 28.72, and reverse down lower to the 200 simple moving average. So as far as the NASDAQ futures, they fared a little better than the S&P 500 futures over this period. As you can see, it actually held above the 200 simple moving average, reversed back higher, and it's actually currently at its 78.6 retracement line, and it wasn't able to push through that on Friday. So we'll see next week if it's able to push past that and on up to fresh new highs with a current target of 72.87, which is the 1272 price projection. So we'll see if that's possible, but once again, we don't know. All we can do is look at what we do know and try to make the best decision and trade our trades accordingly to that. So after the NASDAQ, one other thing I wanted to look at was the VIX. The VIX, as you know, got really high the last couple of weeks. When the market started declining, the VIX, a lot of volatility came back into the market, and it peaked up here at a little over 50. But it has since come back down, so that's a good sign that the VIX is declining. As the market is starting to rally here a little bit, so it's not back down to where it has, the normal levels. It's down around 10, 9 or 10. We're still elevated quite a bit above that. We're at 19.46, so it is twice as high as it has been recently, but it is declining off of that 50 by quite a bit. So that's one thing to think about when we're looking at the market. The second thing that I like to look at right now is the put-call ratio. If you're unfamiliar with the put-call ratio, it is a contrary indicator. It's basically measuring the number of puts traded versus the calls each day. So one way to kind of interpret the put-call ratio is anything above 1.0 equals bearishness, because it is a contrary indicator. And we like to look at 1.15 as a good, once it's above 1.15, that's a good confirmation of a positive reversal. And as you can see, the last couple of weeks when we hit that low, that 200 simple moving average, The put call ratio is all the way up here at 1.7, so that's very, very high, and it since came down. It's currently sitting at 0.83, so that is definitely a more manageable level. So that is one thing to keep in mind when you're looking at what the market's going to do next. So another market indicator that would be interesting to look at now, to keep in mind, is the skew index. The skew index, or the blacks, which measures the black swan risk. And this is actually a numerical number that's more important than the skew. So the skew, typically it between a 100 and 150. So we're right at that 131.67. So the way to interpret that today is that at 130 means it's a 10.4% possibility that the market will have a 2 standard deviation move. And at that same 130, it's a 1.9% possibility that we'll have a 3 standard deviation move. So it's definitely elevated, but not as high as it has been. So it is still elevated, still something we need to be concerned with, but it is coming down coming down to a much more manageable level. Between 100 and 150, maybe that midpoint is 125, something like that. So we're at 131, still elevated, but much more manageable. So that's kind of where we're at with the market. So what are we looking for next week? That's a good question. One reminder is that Monday the markets will be closed for President's Day. So we'll not be opening the equity market until Tuesday. So it will be a shortened trading week. I think the volatility will continue to come down back to a manageable level. But again, the question is going to be, and we'll look at that one more time. The question is going to be: is this just a retracement, or are we truly rebounding and looking for new fresh highs? So only time will tell on that. So we're definitely cautiously bullish, but definitely cautious. So with that, I'll wrap up the video here. Hopefully you got something useful out of that, and we'll be back with another weekly summary next week. Have a good week and happy trading.